good morning or good afternoon or good evening or good night. I am not sure where from whichever locations you have been attending my talk, and thanks for taking time and listening my talk. So today I'm going to talk about Arch and GARCH models to before I actually jump into the context of the talk. So let me start with some shameless promotion about me. I'm a self-taught data scientist and analytics manager associated with one of the startup-based company in Hyderabad. And I also call myself as a community person because I've been involved with different Python and data science communities where I work with different communities and help them grow. So currently I'm associated with the following organizations where I perform different roles and responsibilities in each of these organizations. Apart from that, I'm also a passionate mentor and avid speaker. Always look for opportunities to share my knowledge and help people in different areas in data science and machine learning areas. So these are my social handles. If you have any questions, suggestions, complaints, or anything about things, feel free to write it over this platform, and I'll be responding in each and every message of yours for sure. Okay, so here is the agenda for today's talk. We'll give you a quick refresher about our time series, then we'll talk about the overview of Arch and GARCH models, and we'll see the process of the Arch and GARCH models and how we can build Arch and GARCH models, and we'll do some forecasting and everything. We'll see some in action and live, and with that, and I'll wrap my talk accordingly. So without any further delays, let's get started. Time series. There are so many definitions of the time series which are available on the internet, out of which indicate same meaning in a different way. A pretty straightforward definition is sequential data observation matters. Now, when we are talking about time series data, the main aim is to estimate how sequence of our observations will continue in future. So observations are typically collected at regular intervals, like every hour, weekly, daily, monthly, yearly, etc., etc. So depending upon the source of the generation, we may have different frequencies at which our data is collected. And when we are dealing with a time series, one should have really fair understanding about the key components of the time series. So the key components are nothing but like a trend, seasonality, random variations, or cyclic patterns or stationary patterns. So one should aware of all these patterns. One should have a knowledge of all these patterns in order to work on the time series problems or the forecasting problems. Because without having a prior knowledge of these base, so it is very difficult to solve the time series forecasting problems. And time series has like literally spreaded its wings like everywhere, starting from statistics or econometrics to it's been there in bioinformatics and manufacturing industry. So time series has been there in every industry now, so that's why it's like it's everywhere now. Okay, so here comes our main concept called Arch and GARCH models overview. So first we'll start with an Arch process. We'll give you an overview about Arch. Oh, then we'll talk about GARCH models. So Arch are nothing but autoregressive conditional heteroscedasticity models. So we'll talk in detail about each of these notions in a while, but we'll first try to understand what this model and how this model came into the picture. So Arch model was like first introduced by Robert F. Angel in 1982. The reason behind for introducing this model was like as we all know that inflation is like always uncertain, and it is a primary cause of a business cycle. So think from an industry investor standpoint, like we are as an investor, you are not sure how your future prices or wages would be, and in such situations you might not able to may or may not able to invest your money in future, because end of the day nobody wants to lose the money, right? That is a fact. To solve such problems, so we need to have a time series problems with a variance that changes over a time. So what Robert has done is he has squared the residuals and fitted a autoregressive model. That's how the Arch model came into the screen in his paper called Autoregressive with the estimate of a variance of UK inflation. So that was his paper, and that's how the Arch model came into the picture. Uh, came into the picture now. Now, in traditional time series model, we are been modeling the mean of a dependent variable. For example, we want to predict the future price of a stock in the next quarter. This is what we have been doing, but here we are focusing particularly on the conditional variance. The reason behind is like investors and financial institutions may not only be interested in returns, but they also be actually looking into the variance of the asset. So they're not only focusing on the return, but they also keep a tab on the variance of the assets. So that's why, like, variance also plays a key role. That's what the arch models is all about. Now, with the help of ARMA and arch, we can use to explain this conditional mean and conditional variance. That's the beauty of arch model. Now let's talk about the GARCH. So GARCH is nothing but a generalized autoregressive conditional heteroscedasticity. Okay, so sorry, I forgot a point here. I forgot to tell you about the notions of the arch point. So we'll start with the heteroscedasticity. Heteroscedasticity is nothing but so in English language. I mean, if you see in the dictionary language, so we have a meaning called no, hetero is nothing but a different, and scedasticity is nothing but a dispersion. So if you look at the statistics, we have a most commonly measurement of a dispersion called standard deviation and variance. Uh, but in our goal of arch, we are focusing only on the conditional variance. So to put it in a simple way, heteroscedasticity is nothing but the volatility. Uh, and the next we'll talk about the conditional. Conditional is nothing but the conditional property where your one value depends upon the others. And finally, the autoregressive is nothing but depending upon the previous value. I'll not talk in detail about the autoregressive here because autoregressive altogether a different concept. I assume you are already aware of autoregressive models. Uh, yeah, so what we are doing is we are taking the previous values to measure the variance here. So that's how the arch model constructs here. Okay, coming back to GARCH. So GARCH is a generalized autoregressive heteroscedasticity model. So this model is an extension of a arch model, and it was introduced by Boleslav in 1986. So what we do in GARCH model is like the conditional variance is expressed as a linear function of the square root values of the series, meaning that GARCH model allows us to measure the conditional variance as a ARIMA process here. ARMA, with the help of ARMA process, we are able to measure the conditional variance here. And with the combination of with the GARCH, we can combine moving average and autoregressive components in the heteroscedasticity variance. So that's what we do. So to summarize the overview of a GARCH and model, the overall objective of these two model is to analyze and forecast the volatility. So that's what the ARCH and GARCH models does in a real time. So some of the examples on the same for Arch and GARCH model. So these are the examples based on some financial data and econometrics data. So if you look at the first figure, which is basically the absolute figures of a daily log return of a S&P 500, where you can see the volatility here. And if you also look at the absolute figures of a change in BP dollar by exchange rate, you can see how the volatility fluctuations here. And the same goes with the risk-free interest rate. You can also see the absolute figures of the lag here of the risk-free interest rate. And finally, you can see the absolute deviation of inflation rate from its mean. So all these visuals are like time varying volatility. So you can see how the volatility has been changing between the different time periods. So that's what this example is all talks about here. Now, let's talk about Arch model process. So before I actually deep dive in and talk about Arch model process, let's try to analyze or understand in which situations or which cases we actually use the Arch models. For instance, let's say we are fitting the ARP model, and we can see that the residual looks like a full of a white noise, but we are concerned about the decay of P lag wells on the ACF plots of the series. So I'll talk in detail about the ACF and PACF plots in the next coming slides. For now, just follow me with the flow to understand the context. So during this process, what we can do is if we are able to figure out that we can apply the square of a residual as well, then in that case we can confirm and say that we have a positive indication saying that arch is an appropriate in this particular case. To put it in a simple way, so we can say that arch model is indeed or not when by squaring the residuals and examining the ACF plots. And we during this process, we also need to make sure that our mean of variance should be mean of should be a zero, and also there should not be any trend and seasonality patterns in order to apply Arch model for our time series data. This is something we should remember while we are building the Arch model process. Okay, now let's try to understand this ARCH model process. So we'll begin with ARCH-1 process here. So there are so many mathematical formulas and equations involved in terms of explaining the ARCH model process. But what I decided is like I really don't want to show all the formulas and equations behind this process, because to be honest, I really do not want to scare you with so much of mathematics here. So instead, what I've done is like I picked up an example and to walk you through the process and also the underlying math behind this each process, so that you can grab the context easily. Yeah, that was my motive behind putting this example here. Okay, so the ARCH-1 process is so here. This is an example of a simulation of 100 observations of a ARCH-1 process and AR1 AR by ARCH-1 processes here. Now, if you look at the first visual here, which shows the white noise, so white noise is meaning is nothing but all variables are independent, identifying with a mean of a zero here. So these are all independent variables with a mean of a zero, which you can see in the white noise. And next we have the conditional standard deviation here. So the conditional standard deviation indicates it's a EET. So what we do, so to mathematically explain this process, what we are doing is sigma t here. So where we are doing root of 1 plus 0.95 sigma alpha of t minus 1. So so these are the parameters which have been used in this example. So what this formula is basically doing is it's generating the conditional standard deviation process in this example. So when we apply this technique, so it generates a conditional standard deviation process. Okay, once the conditional standard deviation process is done, so now we can see the arch process here, so which we can see, which are seeing in the visual 3. So how we can achieve this arch process is mathematically when we apply the alpha t equals to sigma t plus et. So the et is not, so et is nothing but the error term here, and the previously t minus 1 are nothing but we are considering the previous values for our arch models here. So now the ARCH-1 process can be used as a noise of a AR model here, so which you can see here, so which you are seeing in this particular case here. So once we have done this ARCH process, now what we are doing is, so here the parameters here are the mu is equal to zero point 0.1 and the phi is equal to 0.8 in these parameters. So once we have done now we are calculating the variance of our vertical axis. So the variance of our vertical axis is like with y of alpha of 0 equals to this is the formula where now we are taking 1 of 1 minus 0.95 figures, which the parameters here, which results to a standard deviation of a 20. So our standard deviation is equal to root of 20, which symbolizes a 4.47. Now if you see the visuals from e to h here, E to H here, the process of arch and also the arch squared. So if you observe, the arch process does not have any correlation here, but if you see the arch square, it has a correlations. This is something which really we need to understand, and it's an important when we are building the algorithm. So during the arch process, we do not see any correlation, but when we apply arch square, so we'll see the correlations coming into the picture. So that is all about arch process. So maybe at this point, if you are not able to, I somehow is that it's quite difficult to understand the underlying method or by listening into theoretical. But don't worry, we have some practical way how we can deal with in a practical approach. I'm sure you'll get a clear idea about what's happening in this visuals and underlying math behind this process. And now, similarly, the same thing goes with the Arch2 process. Like what we are doing is, since here in the previous one we have taken the previous day values. Here we are taking the previous 2 days values, and we are constructing the Arch model, and the same thing up to the P process, like up to the number of observation which we want to take. And our final formula looks like this. This is how the final formula looks like this. And the parameter used during this are like the p and I are very important parameters in this. Like p is nothing but the number of lag squared residual errors to be included in our arch model, and I is nothing but the lagged period number of lagged period square errors. And one important thing which you like always has to remember while we are building working on arch model processes, like our volatility should not be negative, because our volatility should always be positive. So it doesn't make sense like if the volatility is actually negative in match model process. So that is something important you should keep in your mind. Next, we'll see the GARCH model process. So the GARCH model process is, so this example is an extension of the previous ARCH model process. As I mentioned that, is a GARCH is an extension of an ARCH model process that indicates a moving average component, incorporates a moving average component with an autoregressive component. So you have both moving average and autoregressive components involved in GARCH component. So the GARCH one here are nothing but, we have a one autoregressive lag and one moving average lag. So the one by one is nothing but lag values here of autoregressive and the moving average. And comparatively with Arch, GARCH purchased like a wide range of a behavior, in particularly with more persistent volatility. So you'll see the volatility much like persistent, much better comparatively with the Arch model. So that's the beauty of Arch model. So I'll not walk you through the all steps which I have talked in the Arch slides. Again, the process all remains same. But I would like to stress an important point here. So now, if you see the visuals from E to H here, the conditional standard deviation is not much bursted comparatively with the arch process. So you see here, the bursting of the variance bursting is very less comparatively with what we have seen in the arch one process visual. So that's the key here of GARCH one modeling processes. And so these are the parameters which we have been used to solve this example of the GARCH one process. And similarly for GARCH PQ, so this is a formula here, theoretical formula. So where what we are doing is like alpha I and the BJ are basically the parameters of our model here. And what we are doing is when we are calculating the moving average, so it is basically taking the values based on T minus J. So when we are applying the moving average here, so it is basically taking the values from this T minus J values. So that's how when we are trying to build a GARCH PQ process model works. so uh, I somehow guess that most of you folks have definitely have some blank faces or a confused face at this point of time for sure. But don't worry, try to follow me with the flow at this point. But I'll make sure that by the end of the presentation you really have fair idea about what all we discussed, and because you'll be seeing everything in the practical approach. So I'm sure you'll connect all the dots for sure. So for now, just trust me and follow me with the flow. Okay, next we'll talk about how we can build arch and GARCH models. So as I've been talking earlier that more lot about autocorrelation and partial correlation plots. So now it's time to talk in detail about all these plots. So these autocorrelation and partial correlation plots are heavily used in time series analysis and forecasting because these plots summarize the strength of a relationship with an observation in any time series or with observation in any prior time steps. So that's the beauty about the autocorrelation plots. Now, with the help of autocorrelation and plots of variance, so we can configure the GARCH and ARCH models, and it can be better understood by looking at the visually. So when we plot the ACF and partial correlation plots, you can understand the GARCH model and ARCH processes much better how the variance is showcasing by looking at the visual. So that's the key role that autocorrelation and partial correlation plots play in the time series. And once we have configured the models, right, so now we'll be subtracting the mean from each observation in this queries and squaring the outcome. So once this has been done, now we can interpret to estimate the values of our P and Q parameters the way we do for our ARMA models. So you'll be seeing all that in a while now. And finally, once we build the model, then our final goal is to forecast the model. So this is how the process works for forecasting model. So for what we'll initially load the data, then we'll plot the visualization, we'll plot the ACF and PCF plots the correlation to see whether there is evidence of a volatility clustering in our in our data plot and over the plots which we have built. And once the visualization has been done, we'll test for arch effects. And so once the test, after the test effects has been done, then we'll see whether we can reject the null hypothesis of a arch effects. Because if we are not able to reject the null hypothesis of arch effect, then there is no point of predicting the arch model, because it doesn't make any sense. When we are able to reject the null hypothesis of arch model, then it says it have a positive indication. Now we are able to predict the estimate of a arch model, which we do in the step 4. Once we have been done, we'll interpret the results. And so that's how the structure of a forecasting model works like. And the same thing goes with the GARCH as well. So we'll load the data, we'll plot the visualization, and we'll test for arch effects. So if the arch effects are available, then we'll estimate or predict the GARCH model. And once the model has been predicted, and we'll interpret the results. So this is how the overall process works to showcase you on a theoretically. So what next we have is like, we'll see everything in action now. So how we can build Gaussian models with the Python and other machine learning stuff. So let me quickly
Kalyan,
go to my,
yeah, I
yeah,
just wanted to remind you, I think we have about 9 minutes remaining of your talk.
sure,
If you want to
sure.
allocate some time for Q&As with the audience, uh,
So,
keep that
so
in mind.
yeah, I mean, like, so just give me in the meantime, I'll just quickly walk through the code and explain the process. I mean, just give me,
Absolutely. Thanks.
yeah, sure. Uh, Sure. So, so what I've done is, yeah, so instead of considering the time constraint, I'll not talk about, I mean, like sample model here. So instead, I'll talk about the model which I built. So in this section, what I've done is like, we are taking the real-time stock data and building the GARCH model to see the volatility of the stock here. So I've input in necessary suspects here. So we are predicting, so I've taken the Tesla stock because Elon Musk is everywhere trending these days. So just for on that note, I've just picked up the Tesla stock here. So I'm giving the data like 2015 to 2020 with the help of Pandas data reader. I'm reading the data and I'm plotting the visuals. Now you can see that we can see the good volatility here, from 2015 to 2020. You can see the fluctuations, how it has been changing from 2015 to 20. Now, this is a good sign for building a GARCH model because it has a quite high volatility here. Now, with the help of a PACS plot, like as I mentioned, as I discussed in the slides, like partial correlation plots, I'm trying to plot here the partial correlation. Now, you can see that up to 3 lakhs, it has a very good increasing trend, and slightly it got decreasing in the different periods. Now, considering the 3 as our lag parameters for P and Q, so I'm building the GARCH-C3 model, which is nothing but 3 autoregressive lags and a 3 moving average lags here. So P is equal to 3, Q is equal to 3, where I'm building constructing the model. I'm fitting the model here. Now, this is how we'll observe the results in the summary part. So if you look at the alpha and beta summary results here, it pretty much shows that but alpha is good so far, but beta is not that great, because if you see, some of the parameters in beta are not that significant here. So what we can do is we are able to drop these values. So again, so what I'm doing, I've dropped the values. Now I'm taking the GARCH again. I'm taking the process as GARCH 3.0, which is nothing but R3 here. So in here, I'm passing the P is equal to 3 in Q is equal to 0, because I've dropped the previous Q values here. Now again, I'm plotting, build the model and summary. Now you can see that our parameters looks much consistent here. Now we are good to consider this model. Okay, now that we have a good prediction estimate, now how can we decide whether our model is able to predict the volatility of a Tesla stock very well or not? So with the help of rolling forecast origin, so we are predicting. So here I'm taking the test size as a 365 days. What it will do is like it will calculate the GARCH modeling process for each of the day in 365 days and predict for the next day out. So that's how the process will work here. So I'm taking all the 365 days here and the rolling prediction. When I visualize, now you can see here. So the orange line is nothing but the true returns, which you have seen in the above plot, like the same plot, actual returns, and the predictor one is you are seeing in the purple line. Now you're so here our objective is not to not to compare like how both are like how both are like similar. Like, so not, I mean to say how how our line exactly matches line with the purple line. My goal is to say how the predicted line is catching up the volatility when the actual return is also jumpy. Like when actual return is also jumpy, our predicted volatility is also able to catch up. So this is where our GARCH model is able to catching up all these things. So that's the beauty of the GARCH model here. And so I've done the same example for other I mean like other equity for S&P here, but the final thing I would like to show you is once we have I mean like once we have taken build the like visualize the predictor volatility, now it's time like we have to forecast our model. So what I've done here is for S&P equity, so we have built till the visualization. I mean you have seen all this part in the previous one. Now I'm forecasting, I'm going to predict the next 7 days how my model will able to predict, how my GARCH model will able to predict. So for that I have taken the 7 days. Now you can see that so it has been increasing, it has been slightly decreasing in this particular date. Again, it's increasing, it's been decreasing, and overall, this is how. So now this is how we can forecast the model. Like this forecast is for shorter term, but when we go for long term, right? I mean, it becomes less certain. So it's always good to look for the shorten time margins. But these, so to conclude that, these plots, like these plots really play important role for people who are like watching the movements of the stock market or the investors. They can make a decision whether to buy or sell the stock based on if it's going to be very volatile or completely not. So this plots plays a very key role in terms of understanding. And finally, I would like to say that the data and the plots which I've shown they are discussed about all the financial data or the financial thing which I talked is purely to guide you the concept of arch and gods. I mean, like which is not nowhere I'm addressing for an investment purpose. So this is something you should keep in mind. And with that, uh, these are the references for the talk. With that, I'll conclude my talk. And if you have anything for me, feel free to write in this platforms, and I'll be happy to address the questions for sure. And yeah, with that, I can conclude my talk now.
Excellent. Thanks, Kalyan. Thanks very much. I've always been quite interested in ARCH and GARCH models, so this is a nice, quick overview of it. There are, I think, two questions in from the audience. I can show them on the screen. The first one is by Kirill Gunkin. This person is asking, what are some recommended packages for Python to use ARCH or GARCH?
So yeah, there is a there is a package of Arch packages available on Python, so you can explore the Arch package of Python. So maybe let me just me go to my code notebook. I'll just share you here. So yeah, so this is how I'm just giving the import idea here. But so where can I paste? I can paste it in the chat or comments. I think I don't have, right? Okay. I can tell you that there is a package of Arch. Maybe if you can Google right, Python Arch, so you'll find it the package name. So yeah, you can start using batch, and you can start exploring playing with the Arch and GARCH models.
Yes. Oh, yeah. Sorry. Sorry about that. So, yeah, you can also paste the link in Discord. If the audience join us on
Yeah.
Discord,
I
I think
mean,
that'll
like
be quite useful
correct,
to share.
correct. You can
Yeah.
ping me in the Discord. I mean, like I'll be there in the Discord. I'll do that. Yeah.
Excellent. And one last question before we wrap up. There was a question by Glenn Lehman. Is the code available for us to review?
Yeah, sure. I mean, like I'll share the code notebook. So I didn't publish it. I mean, like I built it in yesterday night. I was just sitting and writing all this code from scratch. So I didn't get a time to publish it. But I'll definitely do it, make it public for sure, because it's everything is open source, right? So there is nothing
Yeah.
complicated here. Yeah.
Excellent. That's very nice to know. All right. Thank you very much, Kalyan, once more for your quick tour of the Arch and Garch models. It's a very nice talk, and I'm sure the audience is very appreciative of it. All right.
Yeah.
Thank you.
So thank you so much for having me in PyData again. It's an honor to speak here, and yeah, I'll see you all around. Have a great conference.